Welcome to ES Gold. This is your daily outlook for gold, XAU USD, for Monday, the 29th of June, 2026. Today, we analyze gold's sharp Friday rebound back above $4,000, the fragile ceasefire and Hormuz threats in the Middle East, the hawkish Federal Reserve Under-Chair Kevin Warsh, this week's holiday-shortened calendar featuring non-farm payrolls, and the key technical zones for your trading today. Where gold stands. Spot is trading near 40.85 to 40.90, staging a strong recovery after a volatile week. On Wednesday, gold crashed to a 7-month low near 39.59, but Friday saw a sharp rebound of nearly 2%, closing the week around 40.89. While the higher time frame remains bearish, price is holding above the psychological 4,000 mark, setting up a key short-term battleground. What changed heading into today? The market presents a classic tug-of-war. The macro ceiling remains heavily bearish due to a hawkish Fed, a strong dollar at a one-year high, and hot PC inflation data. However, the short-term floor is supported by oversold technical conditions and a fragile U.S.-Iran ceasefire. Renewed threats around the Strait of Hormuz have revived the safe haven bid, sparking Friday's relief bounce. Base case for today, neutral to bearish range-bound trade. Expect choppy movement around the 4,000 to 40.60 pivot zone, inside a wider daily projected range between 38.20 and 41.14. Holding above support at 40.08 keeps the short-term bounce alive toward 40.60 and 41.14. A daily close below 39.52 exposes 38.94. Driver 1. Geopolitical risk. The 60-day U.S.-Iran ceasefire signed on June 17th is looking increasingly fragile. Iran threatened to reclose the Strait of Hormuz following strikes in Lebanon. Drawing a stern response from the U.S., weekend diplomacy has established a deconfliction cell, but rhetoric remains hot, with Khamenei warning the U.S. and Israel drawing red lines. This tension has reintroduced a geopolitical risk premium, supporting gold's Friday bounce. Driver 2. The Federal Reserve under Kevin Warsh. The Fed held rates at 3.5 to 3.75% at the June 17th meeting. However, the new dot plot took a hawkish turn, with 9 of 18 members now projecting a rate hike before the end of 2026, lifting the year-end median to 3.8%. Futures now show roughly a 68% chance of a September hike, which is structurally bearish for gold. Driver 3. The dollar and yields. The hawkish shift from the Federal Reserve has pushed the U.S. dollar index to its highest level in over a year. At the same time, Treasury yields remain elevated. The inverse relationship between gold, the dollar, and real yields is currently the dominant headwind for the metal. Rallies are likely to face capping unless we see a correction in the dollar index. Driver 4. Inflation data. May PC inflation, the Fed's preferred metric, came in hot across the board. Headline PCE rose to 4.1% year-over-year, its highest since April 2023. Core PCE remains sticky at 3.4%. Resilient consumer spending and rising energy costs from the Iran conflict keep inflation concerns front and center, bolstering the Fed's higher-for-longer rate path. The economic calendar for this holiday-shortened week. Due to the Independence Day holiday, the crucial June non-farm payrolls and unemployment rate are brought forward to Thursday, July 2nd. Ahead of that, we have Dallas Fed manufacturing today, consumer confidence on Tuesday, and ISM manufacturing along with JOLTS job openings on Wednesday. Labor data will be the critical swing factor for the dollar and gold bias. Driver 5. The structural bull floor. Despite near-term pressure, central bank buying remains highly supportive. Official sectors purchased 863 tons in 2025 and another 244 tons in the first quarter of 2026. Large institutions are scaling in near support. Major banks maintain high long-term targets, with Goldman Sachs at 4,900, UBS at 5,900, and Wells Fargo targeting 6,300. Technical trend analysis. The overall trend remains bearish as gold trades below its 20, 50, 100, and 200-day simple moving averages. The daily 20-day average is dynamic resistance near 42.72, while the 200-day sits around 44.75. A formidable supply zone lies between 41.14 and 41.57, which is expected to cap near-term recovery attempts. Technical momentum and indicators. While the trend is bearish, momentum indicates gold is stretched to the downside. Daily RSI is recovering off oversold levels and currently sits near 34, leaving room for a technical bounce. The daily MACD has flattened near the zero line, indicating selling pressure is neutralizing. A hammer and doji candle sequence near the 40.08 support area points to short-term basing. Resistance levels above. Immediate resistance is 41.14, the daily range high. Above that sits 41.57, which marks the top of the daily supply zone. Higher targets include swing resistance at 42.02, followed by the bull extreme near 42.55. Bulls need a sustained, high-volume break above 41.14 and 41.57 to shift the near-term narrative. Support levels below. The first line of defense is 40.08, which is the hammer zone and the key bull-bear pivot. Below that is 39.52, which serves as the short trigger. The critical shelf is 38.94, the weekly low projection. A break below 38.94 would open the door for a deeper correction toward the daily range low projection near 38.20. The daily trade map. The supply zone for fading rallies is 41.14 to 41.57, with a protective stop placed above 42.02, targeting 40.08 and 39.52. The buy zone for trading the bounce is 40.08 to 4100, with a stop below 39.50, targeting 41.14. With spot near 40.85, wait for a pullback to support or a test of supply. Scenario A, the primary path with a 45% probability, oversold bounce and range play. Gold defends the 40.08 pivot, supported by the fragile Hormuz ceasefire risk and oversold momentum. Upside is capped near the 41.14 to 41.57 supply zone, leading to sideways consolidation into the midweek jobs data. Strategy is to buy dips near 40.08 and sell rallies near 41.14. Scenario B, with a 35% probability, bearish continuation. Rallies fade quickly as the hawkish Fed stance and a strong dollar reassert control. A breakdown below 39.52 invalidates the bounce, opening paths to 38.94 and the 38.20 target. This path would be accelerated by a hot non-farm payrolls print on Thursday. Strategy is to sell rallies into supply. Scenario C, the wild card with a 20% probability, bullish extension. A full closure of the Strait of Hormuz or a collapse of the ceasefire triggers a major safe haven spike. Alternatively, a weak jobs print cools yields and the dollar. A high-volume break above 41.57 targets 42.02 and 42.55. Dip buying by central banks helps establish a firm long-term bottom. Risk management and guidelines. Due to two-sided event risk and lower liquidity ahead of the holiday, keep position sizes conservative. For longs, place strict stops below 38.90. For shorts, place stops above 42.02. Monitor the dollar index, treasury yields, and Middle East developments in real time. Never let conviction override risk management, and trade the levels carefully. The bottom line for Monday, June 29th. Gold has reclaimed the 4,000 handle after a brief dip, but faces a heavy macro ceiling of high inflation and rate hike threats. The near-term bias is neutral to bearish, with the line in the sand at 40.08. Sell rallies into supply, watch the support floor backed by central bank demand, and manage your risk ahead of the critical jobs data. That is your daily gold outlook for Monday, June 29th, 2026. If you found this analysis helpful, please like, subscribe, and hit the notification bell so you never miss an update. This presentation is for educational purposes only and does not constitute financial advice. Trade safely, protect your capital, and we will see you in the next video.